Okay, so welcome to the deep dive. Today we're diving into something a lot of you have been asking about, the stock market. It can seem pretty overwhelming, right? All those numbers and graphs and jargon. Our goal today is to kind of break it down and give you the essentials, the stuff you really need to know. We've got this great intro guide we're using to get us started, and hopefully, by the end, you'll have a solid grasp on what the stock market actually is, why it even matters, who the major players are, and how it works. At least the basics.
Sounds good.
No need for an economics degree here. We'll keep it nice and straightforward. So let's just jump right in. In the simplest terms, what exactly is the stock market?
Well, think of it as a marketplace. Basically, a place where you can buy and sell things. Except in this case, instead of buying and selling like, groceries or clothes or whatever,
Hmm.
you're buying and selling ownership in companies.
Okay, ownership. So, like, I'm buying a piece of a company.
Right. These pieces are what we call shares. They're like little slices of the company pie.
Shares, got it. So, if the company does well, my slice of the pie gets bigger, more valuable.
That's exactly.
Now, how do these slices even become available in the first place? I've heard of this thing called an IPO.
Yeah, an IPO. That stands for Initial Public Offering. That's basically how companies offer these shares to the public for the first time. It's like they're saying, hey, we're giving you a chance to own a part of our company.
So they're inviting people to be part owners.
Exactly.
Okay, makes sense. Now, where do these shares actually get traded? I always hear about the NYSE and NASDAQ. Are those like the main hubs for all this buying and selling?
Yeah, you got it. Those are the big ones. The New York Stock Exchange and the NASDAQ. Think of them like giant auction houses, but instead of art or antiques, they're trading shares of companies.
So it's like a constant auction going on?
Pretty much. They have all these systems in place to handle the buying and selling. Makes it all work smoothly.
So companies offer shares, people buy and sell them on these exchanges, but what makes the price of a share go up or down? It seems like it's always changing.
It is. And it all comes down to that basic economic principle. Supply and demand. If more people want to buy a certain stock than sell it, the price goes up. Simple as that.
Like if everyone wants the new iPhone, but Apple can't make enough of them.
Exactly. The price goes up because there's more demand than supply. Same thing with stocks.
So the price is basically a reflection of how much people want that stock at any given time.
Right. It's all about how investors perceive the company's value and potential.
Okay, so we've covered what the stock market is and how it works on a very basic level. Now, for someone who isn't actively trading stocks, why should they care about any of this? I mean, what makes the stock market so important in the grand scheme of things?
Great question. And it's important to remember the stock market has a huge impact on pretty much everyone, even if they're not directly buying and selling stocks. First off, it's how a lot of companies get the money they need to grow and expand. They raise capital by selling shares.
Right, like with those IPOs we talked about.
Exactly. That capital allows them to invest in new technologies, hire more people, create new products and services. All those things help the economy grow.
So even if I don't own stocks, the fact that companies are raising money through the stock market can indirectly benefit me?
Yeah, through job creation, innovation, things like that.
Okay, so that's one reason it matters. What else?
Well, the stock market also gives individuals a way to invest their money and potentially grow their savings. It's a way to participate in the growth of successful companies.
So aside from just companies, individuals can benefit too.
Right. And, the stock market is often seen as a kind of indicator of the overall health of the economy. If the market is doing well, it generally means investors are confident and optimistic, and that can spill over into other areas of the economy.
Like people are more likely to spend money if they think the economy is strong.
Yeah, and businesses are more likely to invest and hire. It's all connected.
So if the stock market tanks, it could be a sign that there's trouble brewing in the economy.
Potentially, yeah.
I never really thought about how interconnected it all is. It's not just some isolated thing happening on Wall Street.
It's definitely not isolated. It affects interest rates, employment levels, consumer spending, all sorts of things.
Okay, so we get what it is and why it's so important. But who are the main players in this whole stock market game? Our guide mentions a few key groups.
Yeah, there are a few. You've got your investors, obviously. Those are the people buying and selling the shares.
Right. Anyone from individuals like us to these big institutional investors.
Exactly. Then you've got the companies themselves. They're the ones issuing the stock in the first place.
And then there are those stock exchanges we talked about, the NYSE, the NASDAQ.
Yeah, they provide the platform, the rules, all the infrastructure for the buying and selling to happen.
And lastly, there's something about regulators. What's their role?
The main regulator in the U.S. is the SEC, the Securities and Exchange Commission. They're kind of like the referees, making sure everyone plays by the rules.
So they're there to protect investors and prevent any shady stuff from happening.
Exactly. They make sure the market is fair and transparent.
Okay, so let's try to put it all together. Can we walk through a simplified version of how a company goes from private to public and how their stock ends up being traded?
Sure. Our guide lays out a pretty straightforward process. First, a company decides it wants to go public. So they issue shares through an IPO. That's step one.
So they're essentially dividing up ownership of their company and selling off those pieces.
Right. Step two is when investors buy those initial shares during the IPO. That's how the company raises money.
So at that point, the money goes directly to the company.
Yep. Then step three is where most of the daily action happens. Those shares start being traded on what's called a secondary market. This is where investors buy and sell shares from each other.
Ah, so when I see a stock price going up or down in the news, that's happening on the secondary market.
Exactly. The company doesn't get any money from those trades. It's all between investors.
Okay, so that explains all the constant fluctuations we see.
And step four is really what drives those changes. Remember supply and demand. Well, if a company is doing well, their earnings are strong, they have exciting new products, people get more confident and want to buy their stock.
So more demand, higher price. Makes sense.
And the opposite is true too. If a company is struggling, investors might lose confidence and start selling their shares.
Which drives the price down.
Right.
Okay, so that step-by-step breakdown is really helpful. You mentioned the primary market and the secondary market. Can we just quickly clarify the difference between those two again?
Sure. The primary market is basically that initial offering of shares by the company through the IPO. That's where the company gets the money. The secondary market is where all the trading happens between investors afterwards.
So the company's not involved in the secondary market at all?
Not directly, no. It's just investors buying and selling from each other.
Like buying a new car versus buying a used car.
Perfect analogy.
Okay, now I often hear about these things called stock indexes, like the S&P 500 or the Dow Jones. What are those exactly?
Stock indexes are basically ways to measure the performance of a group of stocks. They give you a sense of how a particular part of the market is doing.
So it's not just one company's stock, it's a bunch of them combined.
Right. Like the S&P 500 tracks 500 of the largest companies in the U.S.
So if you hear the S&P 500 is up, it means those big companies are generally doing well.
Exactly. Then there's the Dow Jones, which tracks 30 major companies.
And the NASDAQ Composite, which focuses more on tech companies, right?
That's right.
So these indexes are like snapshots of how different parts of the market are performing.
Yeah, they're benchmarks that investors and analysts use to track the market.
Okay, we talked about supply and demand being the main driver of stock prices. What are some of the specific things that can cause those shifts in supply and demand?
Well, one big one is company earnings reports. When a company announces how much money they made, it can really affect their stock price.
So if they had a good quarter, their stock might go up.
Right. And if they had a bad quarter, it might go down.
Makes sense. What else?
News events can have a big impact too. Anything from a new product launch to a scandal or a change in leadership.
So basically any news that makes investors feel more or less confident about a company.
Exactly. And then there are broader economic factors like interest rates, inflation, global events, things like that.
So it's a constantly evolving landscape.
It definitely is.
Okay, so given all that, what are some of the pros and cons of actually investing in stocks? What are the potential rewards and risks?
Well, on the plus side, stocks have historically offered the potential for really good returns over the long term.
That's the main attraction for a lot of people, right? The chance to grow their money significantly.
Yeah. Stocks are also generally pretty easy to buy and sell. It's a liquid investment.
So you're not stuck if you need to get your money out quickly.
Right. And some companies pay dividends, which is like a bonus payment to shareholders.
So you can earn some passive income from your investments.
Exactly. But on the downside, the stock market can be very volatile. Prices can go up and down quickly, and there's always the risk of losing money.
It's not a guaranteed win.
No, definitely not. And investing in stocks takes some time and effort to do it right. You need to research companies, understand the market, manage your portfolio.
It's not something you can just jump into blindly.
Not if you want to be successful.
Well, this has been a great overview. It's really helped me understand the basics of the stock market. So just to recap, the stock market is a marketplace for buying and selling ownership in companies. It's important for both companies to raise money and for individuals to invest their money. And the price of a stock is determined by supply and demand, which is influenced by a whole range of factors.
That's a great summary.
So for all of you listening, here's something to think about. Given everything we've discussed, what do you think would have the biggest impact on whether a company's stock goes up or down? What kind of news or events would make you want to buy their stock or make you want to sell it? It's a complex system, but hopefully now you have a better foundation for understanding how it all works. Thanks for joining us on the deep dive.
Thanks for having me.